Hello, my name is Randy Goldsmith, and I'd like to welcome you to this presentation on investment capital. I've had a very unusual and unique opportunity over the last 20 years to engage directly with more than 1,000 entrepreneurs seeking their first round of investment capital. My challenge during those engagements was to assist entrepreneurs in becoming fundable deals. Of course, not all were successful, but more than 200 were. The successful ones have now raised more than $600 million. For every entrepreneur who eventually became investor ready using the venture capital tools process, 50% received funding. However, regardless of how good the entrepreneurs are or how exciting the product and market opportunity is, without having access to investment capitals, the deals do not get to market. I often say any community without access to a pool of high-risk, patient investment capital is at a competitive disadvantage to the nearest community that does. This discussion focuses on investment capital. Each year in the United States, there are 500 to 600,000 new businesses started each year. Most of those businesses are self-funding, starting with a few $1,000s. Approximately 50,000 or so are initially funded by investors. The amount of investment each year from the investors is roughly about $25 billion. The average per deal is about $500,000. At that level of investment, there are usually several investors investing in the deal to make up that total of $500,000. Some of these companies will eventually seek investment from venture capitalists to invest on average of about $7 million per company. This presentation will discuss types of investors, what investors look for in an investment, the investment process, and investor expectations. First, it's important to realize there are many creative ways to finance a company. However, it usually boils down to some form of debt or equity. Young companies with huge market opportunities to solve gigantic market problems frequently have financial needs that exceed the capacity of conventional lenders. Conventional lenders provide debt financing at relatively low rates of interest on a scheduled repayment basis with securitized collateral. These type of lenders have a low to moderate appetite for risk. So, high-risk, uncollateralized debt is beyond their operational limits. In these circumstances, entrepreneurs must turn to equity financing, provided by friends and family, wealthy individuals, or investment firms. When seeking equity investment, it's important to understand the investor and what they need. Keep in mind that serious investors allocate a specific portion of their wealth to high-risk deals. For example, most investors diversify their portfolios with allocations for real estate, stocks, bonds, cash, and something they call alternative asset class investments, or what we call high-risk deals. This class of investment rarely exceeds 5% of an investor's total portfolio, but someone worth several $1 million, this can be a significant annual investment. When considering their portfolios, investors have expected rates of return for each class of investment based on a risk-reward profile. For example, in a good year, a cash certificate of deposit might yield 5% with virtually no risk. Bonds might yield 7% with low risk. Blue chip stocks average somewhere around 11% with moderate risk, while expectations for higher risk growth in emerging market stocks might be as high as 15%. Alternative asset class investments are much more risky than these type of investment vehicles. An investor would have an expectation of more than 20% annualized rate of return for a high-growth, profitable company with an expanding market that's not yet a public company. Likewise, a company that's growing but not yet profitable has a higher risk-reward profile for which investors might demand a 25% annualized rate of return. The same logic applies to even riskier venture profiles, such as companies that only have a product but no sales, or even companies that are only still an idea. Investors demand anywhere from 35% to 50% annualized rates of return based on investments at these stages of development. While many fail to realize a 35% annualized rate of return means an investor would expect a return of 5 times their original investment after an investment period of 5 years. In other words, if an investor puts in $100,000, they would expect about $500,000 in return if they had a 35% annualized rate of return. With investors, it's all about risk and reward. Success is defined by an investor as a company that generates an expected rate of return to the investor. I'll say that again. Success is defined by an investor as a company that generates an expected rate of return back to the investor. Why would an investor invest in a deal that its probability of success is only 1 in 5, or about 20%? The answer is they expect one success to be large enough out of 5 investments to justify the losses of the deals that are not successful. This logic means the investors will expect every deal to be a high-quality deal with the potential of being the one winner, but with a realistic expectation of only 1 in 5 actually succeeding. While equity investment can appear to be very onerous to the company, it has its advantages and disadvantages. One advantage is that it's permanent capital. Once it's invested, it remains in the company until such time in the future when investors have an opportunity to sell their stock. The disadvantage of equity is the entrepreneur has no unilateral means of reversing the decision to accept equity. Equity infuses cash into the company that increases the value of the balance sheet and the company's creditworthiness. However, equity has a higher cost to the venture than does debt. Companies should always pursue debt financing over equity when debt is available. Equity enhances the credibility of the venture due to the market perception that sophisticated investors value the business opportunity as a good one. Along with the credibility comes a dilution of ownership, however. The entrepreneur now shares ownership with the investors. Once the investment is made, the entrepreneur doesn't have to worry about paying the investors until some day in the future when all of the owners and founders and equity investors either realize a profit, take their gains, or a loss. Accepting equity not only gives up ownership but also implies that the entrepreneur is accountable for providing the investors with progress reports, financial accounting, and strategic business decisions. In some cases, the investors have the ability to exercise limited control by participating on the board of directors. At the same time, having additional owners spreads the venture's financial and performance liability. Another advantage is the experience, contacts, and expertise that investors bring to the venture by participating on the board of directors. But perhaps the single greatest disadvantage of equity capital is the challenge of finding investors who not only have the interest and capacity to invest, but ones that share the passion and vision of the entrepreneur. As mentioned previously, there are primarily 3 sources of equity financing. In general, friends and family seldom invest more than $100,000, and in fact, the number is probably closer to $10,000 in any given venture. In the U.S., more than 1 in 10 people are involved in an early-stage company at any given time. Angel investors invest their own money. Angel investments range generally from $50,000 to $2 million. Some angels are classified as passive angels, those who write a check and never engage with the company in any form or fashion. Others are classified as guardian angels, ones that take an active support role with the company. They usually bring knowledge of the market, familiarity with the product, experience in the entrepreneurial ventures, or some other kind of value contribution. Entrepreneurs are generally advised to seek out accredited investors. This is a Security and Exchange Commission definition of an investor with consistent annual incomes in excess of $200,000 a year and a net worth of over $1 million. The venture capitalists raise and manage money from the outside sources such as pension funds, foundations, and wealthy families to create a fund targeted for investments in a certain industry sector with companies at certain stages of development. These funds can range as small as $30 million up to a $1 billion fund size. Venture capitalists typically invest a very, very small amount of their funds in a small number of startup companies. This slide provides the investment industry's nomenclature for stages of development and the associated accomplishments that characterize them. It should be noted there is a parallel description associated with each of these terms. It's not uncommon to hear an early stage investment called an A round. A mid-stage investment is sometimes called a B round, a late-stage investment sometimes a C round. It is possible to have multiple late-stage investments that could be called D, E, F, and G rounds and so on. Ultimately, if things go well, the company will be a candidate as an initial public offering called an IPO or a merger or acquisition with another company. In either case, this exit, what we call an exit, is associated with a point in time when the investors realize a return on their initial investments. Sometimes we call this a liquidity event. This slide identifies which type of investor is likely to invest, at what stages, and the average amount of investment associated with that stage of development. Note that both angels and venture capitalists can and do invest at the seed stage. The difference is that angels invest in 50,000 seed stage deals per year, while venture capitalists invest in less than 300 seed stage deals per year. These levels of investments vary up and down depending on the year, and they're higher when public markets are good and lower when they're bad. When there is no strong market for mergers, acquisitions, or IPOs, venture valuations go down, as do the levels and number of investments. This eventually retards both angel investments as well as venture capitalist investments, since there's no clear path to an exit or an outcome. Investors have very high expected rates of return. This is all a consideration again of risk and reward. For clarification, if an investor invests $100,000 in a seed stage company that's acquired 6 years later, the investor expected rate of return would be $1 million or 10 times their original investment. Keep in mind, investors do not invest in a single deal. Rather, they invest in 5 to 10 deals on the expectation again that 1 or 2 deals will be successful and the others will not generate the expected rates of return. Investors give a pre-seed company less than a 20% chance for success. Success is defined as the potential to return an expected financial rate of return. Likewise, general expectations for success range from 40 to 50 or 60% for seed, early and mid-stage companies, while expectations for late-stage investment are considerably higher than they were for the pre-seed company. This slide identifies what investors look for in an investment opportunity. When I say investors look for great deals, not good deals, it means that to be successful, the company must generate a high rate of return for the investor. Usually only 10 to 20% of the investor's investments will meet that definition. This outcome typically results even after the investor has used the same amount of analysis and due diligence on each of their investment opportunities. A variety of environmental, market, technology, and human factors can derail what could have been a great company into simply being a good company. Good companies don't compete with great companies. Thus, no additional explanation is required when saying investors demand ventures with the potential for exceptional return on investment. To be great requires that the new venture dominate its competition. The greater the number of competitive advantages the company has, the greater the dominance it can exert. Investors place a lot of confidence in proven management. This can vary from simply being knowledgeable about the market or product to being a serial entrepreneur who has founded and managed multiple companies. To be great, means generating large revenues. Large revenues are typically driven by large and growing markets. Investors are particularly drawn to companies that can demonstrate recurring revenue, since it has the effect of financial compounding. Investors are also drawn to business ventures they are comfortable with. This comfort can result from their experience in the industry, familiarity with the product or market, past success with similar business models, or some other comfort zone factor. They are also pleased when an investment opportunity strategically aligns with another investment opportunity in their portfolio. This synergy allows the two young companies to benefit from each other's resources. Angel investors today are very sophisticated and have become generally familiar with the same investment criteria used by the venture capital community. Typically, angels require preferred stock in exchange for their investment. This class of stock means that in the event the company fails, the investors are first in line for any assets remaining after the debt financing obligations are paid. They often make their investment in the form of a convertible note or a combination of convertible debt and preferred stock. If the company does well and secures a follow-on round of funding, the convertible debt will convert to common stock at a predetermined price that is less than the stock price offered to the new investors. The amount of the discount is often tied to the length of time between rounds. The discount to the new price rewards the investors in the previous round for taking the initial risk. Depending on the level of investment, board seats are generally extended to one or more individuals representing the investors. At a minimum, the investors will require board observation rights, which allows them to attend the board meetings. Investors typically want to see a commercialization strategy that forecasts the key venture development objectives during the investment period. Incremental capital advancements are often tied to successful milestone accomplishments. Once the investment is made, investors will expect regular board meetings, financial reports, and factual performance updates. Regular accountability instills confidence in the entrepreneur's ability to execute the business plan. Angels assume different roles based upon their own personalities and their desire to be involved with the enterprise. Entrepreneurs should be diligent to ensure their openness to the investor participation in the venture and that it's consistent with their desires as well. Some entrepreneurs do not want active investors involved while others do. There's no hard and fast rules on this. It will vary with each venture and with each entrepreneur. Some angels are passive investors, which mean they are generally satisfied with performance updates and have no active role in the venture. Active investors are those that generally serve in a formal or informal advisory capacity to the venture. This advice usually involves providing insights from the investor's experiences, contacts, and board input. A guardian angel is the equivalent of an unpaid consultant who actively engages in the strategic and operational planning of the venture on a regular basis. Then there's the interim management angel. This angel will usually assume the role of CEO or some other position until such time as the venture is sufficiently viable to bring in a new CEO to take the venture to the next stage of development. There are several types of angel investors as mentioned, but it's important for an entrepreneur to know that anyone raising serious money is subject to the security rules of the state and federal security and exchange commissions. Many exemptions apply, but it's important to know which ones do and when. Violations of investment rules can lead to future sanctions and potentially even litigation. Most entrepreneurs look for accredited investors. These are individuals who, again, average $200,000 a year in income and have a net worth of over $1 million. Most investors are individuals making independent investment decisions. They may or may not invest with other investors, but generally make their investment decisions independent of other investors. There's a growing trend of investors who will act in concert to review investment opportunities on a fairly regular basis. These groups may range in size from 3 or 4 investors to 100 or more. Investors in informal groups may invest independently or in concert with each other. Some economic development organizations provide assistance in coordinating multiple groups. This provides groups with a source of consistent deal flow and a repository of information on which deals have been presented, which ones have been funded, and which ones are still looking for capital. Formal investor entities are the ones that legally organize and capitalize an investment fund to make an investment in deals from a committed pool of capital. These entities typically organize as an LLC and design their own rules for operations. Some of these groups will hire a fund manager, while others depend on volunteers in the group to manage the business activities. This is usually dependent on the size of the fund. The numbers shown here on this slide reflect the average deal flow statistics provided by a national survey of angel groups by the Marion Kaufman Foundation for the Angel Capital Association. Imagine if an angel group makes 3 to 5 investments per year, they must pre-screen several hundred deals in order to make that number of investments. This slide demonstrates how a venture creates wealth. For illustration purposes, this venture raises 4 rounds of investment before executing an exit. Exits usually occur through an acquisition and occasionally, when fortunate, as an initial public offering or an IPO. However, venture-backed IPOs are few and far between. 300 in a year is an outstanding year. This slide demonstrates that with each round of capital, the venture increases in value through the application of that capital to growing the venture and establishing market share. As sales grow, the net present value of the venture increases. At an opportune point in time, based on market conditions, it becomes reasonable to put the venture in play, or that is, to start looking for that exit opportunity. This is usually accomplished by identifying as many larger companies as possible that might be a potential buyer, and then marketing the company to those buyers and hopefully securing a sale. If the company waits too long to secure a buyer, the company's value could become too great and therefore too rich for these other companies to buy. If the acquisition fails to occur, the investors are stuck with an illiquid investment and no means to cash out. In the event they hold out for an IPO, there's no guarantee that the market will be receptive to an IPO at that point in time. Timing is everything in timing an exit. Even though this slide is dated 2006, it illustrates exit outcomes for the venture capital community that are probably still relevant today. Some years will be better than others. This chart is probably similar for angel investors as well. A rule of thumb in the investment capital world is the 2-6-2 rule. 2 deals will fail, 6 will be from okay to good, and 2 will be great successes. Remember, in investment terms, success is a deal that returns the investor's expected rate of return, one that makes up for all the other underperforming ventures. This point also illustrates why it's important to have multiple investments in a portfolio. Valuation is a term that describes the financial value of the company. To secure investor funding, the entrepreneur will sell stock to the investor. To set a price on the stock requires setting a total value on the business. Setting a price on the business that has little or no assets, no product, and no sales can be a difficult, subjective process. This valuation tool provides 5 methods for determining the venture's valuation. 4 of the 5 methods are driven by the financial pro forma found in the business plan. The greater the amount of actual revenue and actual number of years of operation factored into the calculation, the greater the degree of confidence that can be placed in any one of the 4 methods for valuing a deal. The 5th method relies on responses to a risk readiness assessment and is based on national averages for startup ventures. In discussing valuation, there are some key terms to understand. The term investment, pretty simple, represents the amount of capital the entrepreneur needs from the investors. The term pre-money represents the computed value of the venture before the new money is invested. That is, the value of the company before the new money comes in. Pre-money investment is usually negotiable between the entrepreneur and the investor. Once a pre-money value is determined with the initial investor, that valuation should apply to all other investors in that same round. The term post-money represents the sum of the pre-money plus the new investment. Equity ownership represents the percentage of the investor's investment of the total investment. This slide will give you a little insight into how valuations are calculated and determined from a variety of ways. The first information requested is the average price-earnings ratio for the industry sector under consideration. PEs can range from 5 to 80 given market conditions, but it's important to identify the average PE for that particular market sector. Currently, a PE between 15 and 20 is a reasonable number to use if you're in doubt about finding a number. The price earnings industry sector averages can be found on financial websites and in business newspapers. Next, it's important to identify the amount of investment being sought, and that ranges, and also to identify what stage of development the company is in. Valuations will vary depending on these stages. Remember that a pre-seed stage deal is a concept deal. Seed stage represents a company that probably has a business plan and still in the process of developing a prototype, but yet no product and no revenue. An A round or early stage deal probably has a product, but not yet generating significant sales, where a B round would be a company with products and sales, but not yet profitable, and a C round would be a profitable company, and so on. Then it's important to know and forecast what the earnings are for a 5-year period of time. It's what we call a financial pro forma. And the earnings are what we call EBITDA, that is, earnings before income tax, depreciation, and amortization. And it's important to know those numbers and to factor those into the valuation. If numbers are not available, it will not be possible to generate certain types of valuations such as discounted cash flow, the earnings multiple, or the venture capital method. The multiple earnings method is most appropriate for service-based companies with a history of revenue. The discounted cash flow is most appropriate for companies also with revenue. These valuations are based upon national venture capital averages for pre-money, average investment, and post-money valuations. Valuations will vary by industry sectors and geographic locations. Interpretation of valuations should be taken as a general but realistic representation of industry averages. The valuation is ultimately a mutually agreeable value between the company and the investor. To determine a realistic valuation, it's important to know what is typical within the venture capital industry. This slide shows the national average for pre-money valuations in orange, the national average investment for the stage of development, and the resulting post-money valuation in blue. The actual valuation will vary by industry sector. In other words, the average valuation for a biotech deal will differ from a software deal. However, these variations seldom differ significantly from the national average. The purpose of the venture valuation is to provide a realistic value for the company. Remember, the higher the valuation varies, or the more it varies from the national average for any stage of development, the more difficult it will be to raise money. This chart demonstrates that venture valuation will vary depending on the variables involved and the methods used. The same financial variables were used in each respective valuation above to generate the pre-money and post-money valuations. The purpose of using multiple methods is to get a sense of the range of reasonable valuations. When talking with investors, they are primarily interested in the validity of the pre-money valuation. Let me say that again. When talking with investors, they are primarily interested in the validity of the pre-money valuation. One approach is to pick the method most appropriate for the company depending on its stage of development and revenue history. In other words, a company with 2 or 3 years of revenue could be comfortable using the discounted cash flow method, the earnings multiple, or the VC method. Startup and early stage companies should be and could be more comfortable using the Goldsmith or default method. Another approach is to throw out the highest and lowest valuation and average the remaining 3 to generate a total valuation. Keep in mind that the valuation methods depend on the company's financial projections and are only as good as those projections. Some investors will automatically reduce the company's financial projections by 50% to account for what they consider the entrepreneur's exuberant enthusiasm. At the end of the day, everything must withstand the investor presentation. At that time, the entrepreneur has the opportunity to stand in front of an investor or investors and make an exciting, compelling presentation of an investment opportunity based upon solid business assumptions and an achievable business model. The better the entrepreneur understands the investor needs, criteria, expectations, and investment process, the better the entrepreneur is prepared to secure funding. The better the community stakeholders understand the role and importance of private equity investment, the more likely they are to support a local process for capital formation. Thanks for watching.